inflation, which people expect to fall off a cliff, doesn't fall off a cliff as fast or as meaningfully as people want. And so I will explain inflation as 3 different chapters, and we've seen the first 2 chapters play out. So 2021, chapter 1 was all about energy inflation. And, we all talked about having almost $10 gas at the pump and what does it mean for everybody? And it caused that initial spike in inflation. And then we had it come off, and Sachs called this. He said, we're going to have this sort of double hump. And 2022 was really the story of goods inflation, right? All these prices and all of these things went up because the input costs went up, and we all had to bear the implications of that. But then that started to ebb. And now, if you looked at the tail end of 2022, what I found super interesting was the number of articles I saw about wage inflation. Whether that was Biden using an 1800s era law to prevent a railroad strike, the number of states that increased minimum wage, the trend around unionization. So in general, my thought is that the pendulum is swinging very markedly away from capital and towards labor. And as the labor participation rate stays low and continues to go down, and also it's compounded by an unemployment rate that may go up, right? It's going to be harder and harder to get people to do the work you need at the company you have unless you pay them more. And if that gets exaggerated, then inflation will stay where it is. It won't be as muted and it won't fall off a cliff as people want.
It'll be persistent.
That's my big contrarian wager for this year, is that we see wage inflation that keeps inflation not going down as much as people want.
Here's what I think is going to happen this year. My big prediction is based on, I think the world has too much debt. I think that the economic slowdown coupled with rising interest rates globally and a dearth of kind of asset capital inflows means that there's going to be a lot of issues with a number of debt markets around the world, particularly kind of emerging sovereign debt. Just to give you guys a sense, global debt is about $235 trillion in public and private. That's somewhere between $5 and $15 trillion of interest payments a year, depending on what net rate is on $96 trillion global GDP. And there's another $1.5 trillion of unfunded liabilities in the US and pensions and Social Security and all this other stuff. I think this is the year where a lot of the debt markets start to unravel. The entity that steps in to try and support these unwinding moments is the IMF. And I think that no matter what the IMF does, they're going to look bad. It's sort of like Jerome Powell this past year, right? Like, you raise rates too late, you raise rates too quickly. No matter what you do, it has some adverse effect and impact. It's either inflationary or it impacts growth. And so I think the IMF is going to get a lot of heat for either acting not fast enough or acting too aggressively and causing inflation as a bunch of these markets face credit risk this year. So my big bet is the IMF is going to play a major role, and we're going to be talking a lot about the IMF later this year. I think as a result, the IMF will get a lot of heat, and you'll end up seeing a lot of pressure and political, just like we blame NATO, just like we blame Jerome Powell and the Fed, we'll end up blaming the IMF for a bunch of problems that'll arise. But the natural physics of what's going on is the world has too much debt and not enough growth to cover the debt, the cost of debt. That's it. As you guys know, there's been a big shift in capital allocation. A lot of the folks who were writing big checks into growth rounds are retreating back to writing smaller checks in seed and A rounds. They don't want to write the $20 million Series B. They want to write the $5 million seed and A round. No one wants to kind of follow the valuation. No one wants to set the valuation for these growth businesses, particularly if after this round, you need another big round of capital and no one's sure if someone's going to be waiting on the other end. As a result, we're seeing tons of these businesses run into capital infusion walls. They can't pivot. I think we'll see what we saw in the dot-com bubble, where 99.5% of these companies actually die. The 0.5% that win are going to emerge as the next $100 billion enterprises, the Googles and the Amazons of the world. So there will be light at the end of the tunnel for the winners. But generally, there are hundreds of companies in hardware, in synbio, in biotech, in high growth enterprise software that require significant sales investment expense. A lot of these businesses where the capital intensive nature of the business just doesn't have the market for it right now. And investors are all retreating and they're going to be selective. So,
okay, Sachs, biggest business loser for 2023.
Well, I just, by the way, 100% agree with what Freeberg said, but my biggest loser for business in 23 is the consumer. I just don't understand how the consumer isn't going to finally tap out in this economy. I mean, they have a mountain of personal debt, credit card debts at all-time highs. I think the average credit card rate hit 19.6% last week and is expected to rise even further. The mortgage rates are above 7% now, so forget about trying to buy a new home or sell your home. And your stock portfolio is down too, and now layoffs are starting to pile up. So I just don't understand how we're going to avoid a recession. And you saw, Kashkari saying that the Fed's going to keep raising 5.4% is his prediction. I don't understand how, if rates are at 5.5%, that doesn't finally break the back of this economy and we go into a recession.
Do you think, Sachs, that the economy is actually broken right now? We just don't have the data because the data lags 60 days in most people's minds? Because it does feel like the consumer is just, and real estate has just broken at this very moment.
It seems like it. I mean, the pain is very unequal, right? But in the tech industry, we've been in a recession for a year. I mean, like the growth stocks are down 80%. What Friedberg said is true. No one's going to fund these, high burning companies. There's an enormous amount of retooling that has to happen. Look, I think the recession is here. It's just very unequally distributed, exactly.
But the people that really get screwed, as Jason said, are the common shareholders, because eventually those converts deals that do get done, those people will end up owning the company. The cap table gets completely flushed and reset, and the employees get wiped out.
Yeah, they're wiped.
The people that do all the work get fucked, and the people that do none of the work and who just want to maintain this shell game gets to basically live another day.
White-collar workers with no hard skills, Twitter going down to, I think, Elon said a couple of hundred people is all you need to run Twitter. And I think he said he has 2,000 employees or something like that. He has shown everybody, hey, listen, more can be done with less. These things are overstaffed in a massive way. I think white-collar workers now, the idea that you're going to have 4 offers and you're going to be able to play them off each other is over. White-collar workers, aka surplus elites, people who actually, are mid-managers who don't actually code or don't actually build a product or sell a product, don't actually do real work, as I think many people would frame it in the managerial class or the CEO class. Man, they're going to have a hard time. And this week, Amazon, Andy, cut 18,000 white-collar workers, not the blue-collar, the white-collar workers at Amazon. That was a big turning point. And Benioff, he does not like to lay people off. He considers Salesforce a family. He laid off 8,000.
I mean, the reason's pretty simple, right? Their growth slowed down by 2/3 in the most recent quarter, but they were still spending the same amount on sales and marketing. So when that happens, your CAC payback explodes, right? You go from 3 years payback to like 10 years. So they have to cut costs in order to rationalize their unit economics. And now it cascades, right? Because all of Salesforce's vendors are going to be getting less money from Salesforce because they're tightening their belts. So then those companies are going to have to cut. And the cycle just keeps going and going.
Right. Everybody tightens their belts at the same time, freezes the economy, aka recession.
There will be a deal between Putin and Xi. And they met by satellite late last week to discuss ways to further help each other in 2023. Putin characterized it as a no-limits partnership. You may remember that the two of them inked a $175 billion gas deal in early February last year. That was 3 weeks before Putin invaded Ukraine. I think now Russia is even more dependent on China. We've really driven Russia into China's arms. And I think there will be a big deal, not just on energy, but on agricultural products, mineral products, and rare earth minerals that, Chamath likes to talk about. I think there could be a $1 trillion deal between Russia and China this year, if I was going to go out on a limb and make a prediction.
I think that's the Saudi-China trade. If this happens and oil is sold in yuan, it marks the beginning of the end of the assumption that the US dollar is the global reserve and the risk-free currency in reserve for the world. This year, exiting 2023, it may be the case that, there's historically been this belief and this continuing belief that the US dollar will always be the de facto global reserve currency. And the current mantra is that it's better than the rest. Everyone else is worse off than the US. Western Europe is in trouble, Japan is in trouble, China is in trouble, everyone's in trouble. But if there is a coalition, an economic coalition, a scaled economic coalition that starts to shift the balance of power a little bit. And the US, meanwhile, is taking on extraordinary debt load, spending $1.7 trillion in an omnibus bill, has this massive unfunded Social Security problem coming down the pipe, and are trying to manage multiple funded conflicts around the world. It could be that the US dollar coming out of 2023 starts to trade more like a risk asset and less like a risk-free asset. And so I think that that's my big contrarian bet, is that maybe this year marks the beginning of the end of the US dollar as the kind of global de facto reserve currency based on some of these big trades that I talked about happening.
Unbelievable.
So that would be my big kind of contrarian.
Perfectly said.
I think that there's still a lot of uncertainty in the world and in the markets. And so I'm generally concerned that there's a lot of chop. And so I pick something that's pretty conservative, but I would have a combination of cash and the front end of the yield curve. So T-bills all the way up to 2-year bonds. So you can generate 4.5%, probably by the end of this year, 5% pretty safely owning this stuff while you wait for things to become more certain. And the way that I think about it is that I would rather miss the first 10 or 15% of a rally once we're really done this stuff than try to overcorrect and try to pick a bottom, just because I think that you could lose a lot of money. So I think the goal for this year is to stay resilient and in the game. And so having a bunch of cash on the sidelines ready to pound it in. Meanwhile, a portion of it collecting 5% is not such a bad thing while you wait for the bottom.
Fantastic.
Yeah, my answer was actually very, very similar, which is if Kashkari is right, that rates are going to 5.4% in Q1, why wouldn't you just put all your money in short-term T-bills? You earn 5.5% risk-free.
Yeah.
Like, set it and forget it.
Yeah.
And that's why capital flows are moving hugely right now from equities into bonds, especially if we're going to a recession, which is inherently deflationary.
Worst performing asset, I went with energy because, not that I think it's not important, but it just feels like everybody rushed into it in 2022. So it feels like it's overheated. And if we are in a recession, people might lower consumption in terms of energy and be looking for cheaper alternatives. So it could be overheated. So I went with energy. Chamath?
I think that if we've learned anything from the last 3 years, you have to separate the valuation of a company and how it performs in the stock market with its value in society. So for example, if you look at Zoom's valuation has cratered, but its value in society has probably continued to go up. It's still a massively relied upon tool. The point is that markets do not give you credit for the value in society. They will give you credit when you are about to over-earn, but then they'll pull it all back when they think that you're going to under-earn. So in that lens, I think that tech will have a tough year. I think energy will have a really shit year. And probably the biggest asset class that is going to get pressured is going to be junk debt. And the reason is a bunch of these variable rate loans, when rates are at 5 and 6%, that all of a sudden are like 11, 12, 13, 14% coupons, a bunch of companies will have trouble meeting their debt obligations and will have to restructure the debt or will have to file.
Subcategory of what Chamath just said, I think office towers in San Francisco that is some serious toxic debt, 27% vacancy rates and growing as leases roll. I think that a lot of these buildings, maybe virtually all of the San Francisco downtown is going to be owned by the bank soon, specifically the office towers, because no one wants to be in those skyscraper buildings south of Market, mired in homelessness. Remember, this was the hottest commercial real estate market in the country a few years ago, and now it's the worst.
Look what happened to B-REIT. What do you think about that crazy thing that happened with the Blackstone REIT? I mean, that's nuts. Yeah. Blackstone has a product called B-REIT. It's like a $70 billion exchange-traded fund, effectively. And what it is the ability for individual investors to own access to Blackstone's, commercial real estate portfolio. And they had such a massive amount of redemptions that they had to close redemptions at the end of Q4. And they were worried that the redemptions were going to continue to go up. These are individual investors who basically sees the writing on the wall, as David said, and wants their money out. And so they went to the University of California pension system, and they essentially got a huge infusion of capital. I think it was about $4 billion, where they guaranteed 11.5% interest to these guys for the $4 billion. And they also posted $1 billion of their own equity in the actual REIT to backstop it. What does it show you? I think what Sachs is saying is really right. It may not just be in San Francisco, but with all of these people either getting laid off, with all of these people now working remotely, we may finally start to see the beginning of the reckoning in commercial real estate, which has been an unbelievably performant asset class up until right about now. And on top of that, you have to factor in these much higher rates. And so these building owners, if they financed it, which they invariably have always financed, they have huge variable rate payments that are due on these buildings. The rent rolls are lower. Even people like Twitter is just refusing to pay the rent. So you have to take them to court. So it elongates when they have to pay. And so you could miss a bunch of rent payments and all of a sudden the banks could just go crazy and take ownership of these things.
It's really simple. I've mentioned it before. It's consumer credit. We assume that rising rates and inflation would taper down consumer demand, meaning consumers buying goods and stuff. And that certainly hasn't happened. I'm in Vegas right now. I was in the car yesterday and the driver grew up in Vegas. He's like, I've lived my whole life in Vegas. He's like, I've never seen a December like we just had. It was packed the entire month. He's like, normally in Vegas, it's dead up until Christmas and then New Year's people come into town, but it's normally dead. He's like, I've never seen such a busy month. And I think we see this in the numbers. Consumers are still spending like it's 2021. They're still spending like interest rates are zero. As we talked about, consumer credit is skyrocketing while rates are skyrocketing. And so I think we're going to run into a real wall with respect to consumer credit sometime this year. And you're going to see such a complicated, interwoven market of assets. There's a lot of different ways to trade it, but I think it's going to be, in general, consumers are not going to be able to meet their debt obligations.
Could be mortgages, could be credit card debt. Defaults are coming.
The market has priced in a bunch of this stuff. Obviously, companies like Affirm and, what are they called? Buy now, pay later companies, credit card companies, mortgages. There's a lot of assets that you can start to kind of pick apart. Where do you think this unravels first? What gets hit hardest? What's underpriced and overpriced? Probably a lot of good pair trading to do, as Chamath kind of loves to talk about, with respect to which of these are more likely are less likely to be sensitive to this dynamic, but it's going to be a pretty ugly scene. Consumers just have way too much debt relative to their earnings right now, and it's pretty nasty.
And they have some confidence that they'll always have a job or some way to pay their 4 easy payments.
Dude, muscle memory is serious. You come out of 2021 when you had, it's not just stimulus checks, it was the low interest rate and easy credit availability everywhere. And it's just easy to jump into getting new stuff and cool stuff. And then when you get used to getting new stuff every week or every month, you kind of stick with it and you're like, I don't want to give it up just yet. Not just yet. And so it's hard to kind of step back from spending when you have a new type of lifestyle. And I think that's what's going on.
I think this is an incredible observation. Yeah.
This guy that runs car dealerships, and he sent them out how much incredible money, what a significant percentage of people's income they are spending on their monthly car payments. And people buy these cars that are well beyond what should be kind of a reasonable budget. And the stretching is going to snap this year. Yeah.
Absolutely. Most anticipated trend of 2023 related to yours, I went with austerity. I have a friend who sometimes flies private often, and I was talking to him about his Christmas vacation. This friend of mine, Chamath, instead of flying private to his vacation, he had to pick up his kids, he had to go back and forth. He was driving his car, who would normally fly private to Lake Tahoe. And he's like, no, I can't go out with you skiing on Friday. I got to pick up my kids, and then I'm driving back. I said, wait a second, how are you doing that? He's like, I'm driving a car. I said, what? Who's driving the car? He said, I'm driving the car. And that's why I say austerity is my anticipated trend of 2023.
I agree with you. I actually think this is a really good opportunity to pull back on so much waste. I haven't really looked at my household budget in probably 2 or 3 years. Didn't even bother. And then when I looked at it, I was like, wow, this is really inflated to a level that I didn't expect.
Yes.
But it makes a lot of sense to live in a more heads down, austere way